Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surabhi and Mangalam is joining us today. Guys, hi, good morning.
Good morning. Hi, morning. And Prashant, welcome back. We missed you last week, but we ensured that there's no wider fall, as you would have noticed. Nifty was more or less range bound, but global cues are as exciting and as diverse as ever.
Well, but as exciting and diverse as global cues are, the Indian markets seem to have decoupled a little bit from the global cues itself all of last week. Barring the first trading session where we saw a big decline and thereafter there's a recovery, seems like the Indian markets are now moving on their own tunes.
Looks like it, and hopefully that will be the case. And IndusInd Bank last week.
Yep.
Oh, big headlines, yeah. Never a dull moment, Prashant.
Well, there's always something, and that was, of course, very, very eventful in that sense. Let's just take it from the beginning and just put into context where we are and where perhaps we might be heading, right? So I'll start with the context. U.S. markets have had a tough week. The last week was pretty tough. They've been... Equity indices have been down, I think, now for 4 straight weeks in the US. India, though, held out. That is essentially the contrast that I want to highlight. US down, India not really selling off. And remember, there was that 700 points that India sort of gained from the lows, which could have been given back as the US sold off, but it did not. Those 700 points mainly came the week before last. And then, last week, we kind of managed with a small cut, 0.7% lower. S&P down 2.3%, the Nasdaq was down about 2.4% or so. Now, this is, of course, weekly outperformance of India and, of course, the weekly change in the US. But I must mention that on Friday, Wall Street did bounce back. And S&P was up 2%, largely on the back of short covering and maybe no news. No new news on tariffs, no new news on, Ukraine, Russia. And generally, it was a light session. Volumes, etc., were light with that 2% bounce that we saw on Friday. The big question for global markets, of course, is that is the US market correction over? Remember, at one point, at the lows of last week, from the highs that we saw in February, the S&P had lost about 10%. Typically, 10% drawdowns in the S&P have been good buying opportunities. Will it be the case this time around as well? There is a little more uncertainty right now. That's the change as of Friday's close because we did bounce 2% on Friday. S&P from the highs is down 8%. The 10-year is down about 50-plus basis points, and the dollar index from its highs is down about 5%, a little over 5% or so, which means that the U.S., at least the markets in the U.S., are in some ways, adequately or not is a different question, but they're pricing in weaker U.S. growth, and that's largely on the back of uncertain trade policy. You got to look at sell-side estimates. Everybody's brought down GDP growth estimates for the U.S. because of this. Now, of course, the key to this we'll only know in about 15 days' time on the 2nd of April when those reciprocal tariff bit will come through. And that's the big one in terms of how Trump will sort of play things into the 2nd of April. You can make the case very forcefully that, he's going to go through. Or you can also kind of look at the other side and say, he'll be pragmatic. Markets have corrected. They're down about 8% from the highs, and he doesn't want more damage. So, that's essentially the picture. Next 10, 15 days, I think things will become much clearer. And that's the big one. Reciprocal tariffs around the world, many countries affected here in India as well. We have the Fed meeting on Friday, on Wednesday, beg your pardon. And there is, of course, they will decide with the backdrop being anxiety around US stagflation. And just to sort of, make that point about the concerns around US stagflation, take the data point from Friday, which is the University of Michigan data point. Sentiment fell, inflation expectations jumped. 1-year, 5-year, 10-year inflation expectations jumped. So that's that. Now, most likely, like the last Fed meeting, because there is so much uncertainty, Fed is likely to say, they're in a wait-and-watch mode, wait-and-see mode, nothing very much beyond that. Here in India, we get a bounce this morning because, of course, the 2% move on the S&P. And of course, the fact is, you just think back last Monday when Nasdaq fell 4%, and here in India, we actually ended slightly higher. That's a very, very healthy sign, and that kind of persisted through the course of the last 5 trading sessions. Having said that, I mean, I would say the backdrop is not sell the rallies. It perhaps is if you get big dips, they get bought into. But we've still not been able to cross, after everything last week, we've not been able to cross the 20-day moving average, which remains the resistance. Support comes in at 22,315 and 22,236. Again, very near term, 50-60 points away from where we left off on Thursday. And of course, on the upside, break above 22,676 is needed. We left off at 22,400. This morning, I think GIFT Nifty is indicating about a 100-point higher start. For the Nifty Bank, we ended absolutely flat on Thursday. That's the last trading session. Multiple resistances between 48,500 and 48,840. And here supports come in at about 47,700. I would say the texture perhaps on continuously sell the rallies perhaps has changed a little bit at the margin, although we need to track how things proceed from here. And of course, the big clarity will only come in about 15 days' time. And of course, comments and sort of statements, etc., into the 2nd of April when he's supposed to decide on what to do with tariffs on a broad basis. 140 higher on the GIFT Nifty. Surabhi.
Absolutely, Prashant. When we went into the long weekend, we were awaiting two more data points from the US. We'd seen the consumer inflation print, and that was soft. Producer prices and the University of Michigan sentiment is what, of course, the market wanted to see. So very quickly, like Prashant mentioned, just reiterating the number there as well. The index came in at 57.9. This is for March. The expectation was 63.2. So that, indicated that obviously the consumer sentiment fell more sharply than anticipated. The one-year forward inflation projections are at the highest since September 2022 at 4.9%. However, the PPI data, the producer price inflation number, that was again soft. You can argue maybe that the future numbers will capture the full extent of the inflation expectations, but PPI numbers were below estimates. 0.3% increase was expected. It was absolutely flat. Gold, by the way, managed to move above 3,000. This is COMEX gold I'm talking about, 1 year forward, 1 month forward contract above 3,000. This morning, that contract is just a shade, minor, notch below that. But it gave an indication of, the uncertainty with respect to the course ahead for the US economy itself, which is why gold was rising. The other important point to keep in mind for Friday specifically was the rise in the German market. And the Germans have managed to come together to approve this big fiscal bazooka, which is 1% additional GDP spend on defense and a 500 billion euro package for infrastructure. So that's something that Friedrich Merz has managed to cobble together. He's managed to get the bipartisan support on that. Coming to China, there are lots of data points that are coming out of China over the weekend and this morning as well. Now, China has announced a special action plan to boost consumption. That's number one. What are they saying? They're saying that the incomes should be higher. Not too many specifics right now, but that generally they're saying that in order to boost consumer level demand, incomes should be higher. They'll take more steps to stabilize the property market. They're talking about boosting travel and tourism in the country as well. And over the weekend, very interesting reports on fund managers. Probably not a great idea to be a fund manager in China because if you're going to underperform the benchmark, your salary could be halved by 50%. That's what the Chinese market regulator is stipulating or proposing right now. There's more data out of China actually as we speak, and that's all looking very good. Fixed asset investment growth is above estimates. Retail sales at 4% are slightly higher. This is club data, January and February combined because of the Lunar New Year break. And most of those numbers are actually looking pretty all right. Asian markets have been largely holding up. In fact, if I quickly parse through what some of the market indicators are saying, it's a broad sway of green. The Hong Kong market's up about 1%. It did very well on Friday as well. And the mainland Chinese market is also higher. Even the Japanese market is up 1% higher. So big positive cues coming in from Asia this morning. The Nifty kept seeing consolidation. So the problem really was not with the Nifty last week. It was with the broader market. So I'll again watch out for what the small cap and the mid cap indices do because they were the ones that were still feeling the pain all through last week if you look at indicators. The best cue for us has been the fact that FPI selling has been coming down every single day, barring the day we had the IndusInd Bank episode. The FPI net sell number was lower and that continued. Look at that. For the first time in our, I don't know how many sessions, we are in triple-digit territory, not looking at even 1,000 crore sell, less than that, 800 crores of selling coming through. So that's good news. On IndusInd Bank, just keep the spotlight open because the RBI made some statements after market hours on Thursday, largely to assuage any concerns about the health of the bank. They basically repeated the latest ratios. So capital adequacy ratio of 16.4%. The PCR, provision coverage ratio, is 70%. RBI saying the LCR for IndusInd Bank is well ahead of regulatory requirements at 113%, and saying that depositors should not react to short-term speculation. The bank's financial health remains stable and is being closely monitored by the RBI. Also, the RBI indicated the bank has been directed to take remedial action and ensure all disclosures are made to shareholders and to stakeholders within the fourth quarter itself. So this is something that will keep IndusInd Bank in focus. But Mangalam, like you've been also saying, I mean, largely good that we managed to consolidate. FPI selling intensity has been reducing, and the Asian cues are very supportive this morning.
Yeah, 2 points you all made. One, Prashant saying that maybe the texture of the market has changed from sell on rally to about buy on dips. And for you as well, the FPI selling reducing is something that I'm watching out for. And all of that is encapsulated in some very interesting data. So if you look at all of last week, the Nifty lows have been maintained. And if you look at the Nifty lows as well, and this despite the weakness that we've gotten from Wall Street, etc. March 11, the low was 22,314. March 12, the low was 22,330. And March 13, the low was 22,377. So we have been making higher lows. That is a big positive. The second part is that at higher levels, we are facing supply about 22,500. So to that extent, the GIFT Nifty uptick and that sustaining would be extremely crucial, because if you look at the highs over the last few trading sessions as well, they've been contained around that 22,550 to 22,600 sort of mark itself. And that's exactly where we opened today. So sustaining the opening highs will be very crucial to track. The FII is selling sub 800 crores yesterday. All of March itself, the average has been around 2,300 crores, which in any case is lower than we saw in the previous couple of months. So that is a positive. And there hasn't been any incremental selling by FIIs in index futures. In fact, if anything, there has been incremental buying. So they've bought Nifty Bank and they've sold Nifty futures, perhaps because of weakness that we're seeing in the IT pack itself. So Nifty Bank will be the crucial one to track. FIIs 19% long, 81% short. What are the index option writers hoping for in terms of a range? We have some action at the 22,500 call and the 22,600 call, telling you that there is congestion expected around 22,600 to 22,650. And at the lower level, however, like I pointed out, there have been lows which have been contained around that 22,300 mark itself. So 22,400 put writers and the 22,300 put writers are both extremely active. Short point for the option writers, what they're looking at is support around 22,250 and congestion above 22,600 itself. Just a couple of other data points that I'm looking at from a technical standpoint. Now the Nifty 20-day moving average has come down from 22,750 earlier last week to around 22,587. So that's something we'll watch out for. And can the Nifty Bank make an excursion towards that 20-day moving average or not? It's something that we'll most definitely keep an eye out on too.
All right, Mangalam, thank you very much for that. Let's get in Ed Yardeni, President at Yardeni Research. He's with us. Ed, thank you very much for joining us. I don't know if you saw Scott Bessent's interview over the weekend on the press. Very interesting, right? Here's a market man, when asked about the market falling, saying, well, it's okay, it's normal, it's a normal, healthy correction.
Yeah.
And I think there was also a question on recession. He said, well, I can't say for sure whether there will be or will not be a recession. So they seem to be pretty okay with this fall that we're seeing.
Well, I think a lot of us on Wall Street are disappointed with Scott Bessent. We thought he was one of us. We thought he was a market guy and that he understood that markets mattered. But now he's kind of dismissing us. Now he's not one of us anymore. And that's actually a little disturbing, right? Because markets do matter. Markets do vote. They do give you an opinion. And I think to dismiss a 10% correction in the S&P 500 and more than that in the NASDAQ is fine, as long as it doesn't turn into a bear market that lasts a long time. And they're kind of like messing around with nitroglycerin. This is very, very dangerous to basically tell people that the administration doesn't care very much if we have a recession, because the short-term pain is going to be for long-term gain. And nobody believes that. Nobody believes it until they see it. And meanwhile, Americans don't do pain very well. They voted for a president that they thought would make things better, and they're not that patient. So it could be an issue for the midterm elections.
Is the correction over, Ed, in the U.S., in your opinion?
In my opinion, no. I am it's very bullish to see that bearishness is so high. We have very high bearishness sentiment indicators for the stock market, and that usually makes a low, but the reason it makes a low is because, coincident with people getting extremely pessimistic, is that the Federal Reserve recognizes there a problem, and comes in, and we get the Fed put. We get the easing by the Fed. This time around, the Fed has indicated quite explicitly there are no hurry to lower interest rates. They think the economy is still resilient. Meanwhile, they have all the uncertainty, as the rest of us do, with regards to tariffs and whether tariffs might boost inflation. And the last thing they want to do is lower interest rates, even if the economy is weak, if inflation's actually heating up again. So that's my problem. The other problem is I'd like to see the market do better on a day when Trump is talking about tariffs. I've come to the conclusion that any day without Trump talking about tariffs is a good day for the markets. And that's what we saw on Friday, as you mentioned.
Absolutely. I take that point. But, you know, that the comment was, it caught, I think, everybody's attention, because he wasn't only talking about tariffs, Mr. Besant. He was saying that we are warding off a guaranteed financial crisis. He's talking about the deficit and the spending, right? And he also indicated back to 2007 and 8. He said that at that point, if the excesses had been stopped, we wouldn't have had a full-blown global financial crisis. I don't know. I mean, it seemed to indicate more than just the current tariff issue, which is what the market is primarily fixated on. The government shutdown and the spending, that's not yet so sort of front up in the narrative. It seems the market's problem is tariffs and inflation. But could the government cuts, more spending cuts if they come in, could that kind of feed into it as well?
Yeah, I think that I recall that his predecessor, U.S. Treasury Secretary Janet Yellen, once said that there'd never be a financial crisis again, or she thought it was very unlikely in her lifetime. And then we got the pandemic, and we had a financial crisis. So I think it's always unsettling when you hear a policymaker saying that what we're doing now is going to avert a financial crisis, when the reality is they really haven't done anything to reduce the deficit. If we have a crisis, it's going to be related to the extreme amount of debt relative to GDP in the United States. It's very interesting to see that the bond yield has been very, very quiet, around 4.3%. You would think that with concerns about a recession rising, that the bond yield would come down. That's not happened at all. But I think right now, Besant basically is borrowing a lot of money in the Treasury bill market. And so that's kept the bond market relatively quiet. But there's a lot of securities that have to be refinanced this year. And the debt issue certainly has not been resolved. And there's still lots that has to go through Congress with regards to fiscal policy. All we've done is kick the can down the road with regards to the budget.
Right. You know, Ed, the overarching theme is, or belief is, that Trump is a man of action, listens to business, listens to what, the markets are saying. Do you think with what the markets are making of his tariff announcements, etc., there could be a case for him rolling back some of them, or maybe, toning his narrative down a little bit?
Well, I hope so. I hope he just doesn't remain bullheaded about his tariffs. He has bragged many times and called himself tariff man. And I think all of us on Wall Street, including myself, had the illusion, maybe delusion, that all Trump was really going to do was bluster. He was going to huff and was puff. And then once he threatened the tariffs, that there'd be negotiations to bring the tariffs down. But he's also said that he's really intent on using tariffs to raise revenues, which means permanent tariffs. He's also said that he wants tariffs to discourage companies from producing abroad. He wants more companies to come back to the United States, which means permanent tariffs. And he's kind of compared himself to President McKinley, who also used tariffs to bring revenues into the United States. The risk is the comparison that will be relevant is Herbert Hoover, who signed the Smoot-Hawley tariff. Tariffs are bad news. And right now, it's interesting to see that foreign stock markets are outperforming the U.S. stock market, suggesting that at the end of the day, tariffs might be actually worse for for the United States than for the rest of the world, because the rest of the world is still going to operate with the same tariffs relative to one another.
Got it. So through this, so April 2nd, right? And what happens into that day, and I think that'll be interesting.
Yes.
But it's interesting. It's John Authers, the the Bloomberg columnist now. He wrote a piece saying why Trump cares less about market pain now, and I think there've been others who've been pointing this out as well. I spoke with Louis Gavicle 2 weeks back, and he said, well, he doesn't really care. I mean, they're not focused on the S&P. They're more focused on the 10-year. And when I say they, I mean Trump and Besant, etc. So that's interesting. We'll see. I mean, now that those thresholds are being tested, maybe that Trump put is not here. It's a little lower. Who knows? But India, any thoughts, Ed, and how we are placed? We've already kind of corrected quite a bit. And last week, as US was correcting, the market held on.
I think that's a very good sign, because for a while there, India was going down along with the United States. And both the United States and India had big rallies, and the valuation multiples were stretched. So it certainly looked like global investors were moving out of high-valued stock markets like the U.S. and India and into China and Europe. But it is, I think, encouraging to see that India may be very well bottoming out before the United States bottoms out. And that, look, there's clearly a lot of liquidity in the global economy. And if money is coming out of the U.S. stock market, there's certainly enough to diversify into the Indian market. But I think to the extent that the tariff situation gets worse between China and the United States, I think India benefits from that, because I think more manufacturers will, in fact, move to India. And I have clients who are telling me that's exactly what they're doing.
Oh, okay. That sounds good. We don't mind that at all, Ed. Thank you so much for joining in and giving us that perspective today. Thanks very much.
Thank you.
Well, with that, let's quickly move on. Tell you what else is lined up on the show. At 8:35, we'll have Prakash Diwan joining in. We'll discuss some of the key stocks that are going to be in focus this Monday morning. At 9, we have Kumar Rakesh of BNP Paribas. We'll put the spotlight on the auto sector. Will the numbers start improving in the coming months? Ashwini Agrawal of Demeter Advisors is our market master of the day. He joins in at about 9:20. At 9:30 a.m., we'll be speaking with the management of Brigade Enterprises to talk about the demand trends in the real estate sector. After that, Sanjeev Asthana of Patanjali Foods joins in at 9:40 to talk about the quarter gone by and their outlook for the new year. At 9:50 a.m., we get you excerpts from our exclusive conversation with Warren Harris of Tata Technologies on the automotive industry and growth trajectory for the company. And towards the end of the show, in our special segment, It's the Economy, Lata will be in conversation with Ashish Gupta of Axis AMC to discuss the state of the bond markets.
Right, with that, we will take a quick break. But as we do that, let's also get you a lot of stock-specific action that we'll be tracking today. We'll get to it in just a bit in our special top 10 segment. Today, we're looking at IndusInd Bank, GMR Airports, KEC International, Tata Motors, Welspun Specialty. We have Dalmia Bharat, Oberoi Realty, and Fusion Finance on our radar on the back of positive news flow. And then on the back of negative news flow, there is Ola Electric, SpiceJet, both these stocks on our radar that are likely to open in the red.
Welcome back. Here with us on Bazaar Morning Call. And the cues are actually looking really good because markets around the globe, the US, Europe, Asia this morning, everything's been higher despite all the uncertainties. And that's the indication that we're getting from the implied open. So a bright shade of green this Monday morning. What about individual stocks? Well, our team is standing by with the CNBC-TV18 list of top stocks to watch. Guys, good morning to all of you. I'll start off with Ola Electric. And I think we have Parikshit joining in for that. Do we have Parikshit? Yeah, okay, we do have Parikshit on the phone line. Parikshit, morning. So some reports coming through that one of the vendors is trying to take them towards, bankruptcy filing. What's going on?
Well, yes, a plea has been filed by Rosemerta Digital Services. Now, this is a global firm which works for vehicle registration and high security number plates. This was an agency contracted by Ola Electric to register their cars, register their scooters with the Ministry of Road Transport, and also, secondly, provide them high security number plates. This has happened because Ola Electric does not have dealers. They have direct sales to customers. Now, Rosemerta has filed a plea under Section 9 of the IBC before NCLT Bengaluru, saying that there is a default in payments by Ola Electric to the tune of 22 crores. They filed two pleas. One is for default in payments for vehicle registrations, and the second for default in payments for high security number plates. Now, this is important because early in February, around the 19th of February, Ola had said that there could be some variations in numbers for their February sales because they're renegotiating their contract with their vehicle registration agencies. As per the Vahan data, they sold around 8,647 units in the month of February, and they said that the actual numbers will display in March sales and March Vahan data. That has not happened till now, because till now they have sold around 6,000 to 8,000 vehicles in the month of March, so they are yet to reach that 25,000 number. Having said that, Ola Electric has disputed the claims made by Rosemerta, saying they strongly object and they're going to contest them in court. So let's see how this pans out. But of course, there will be questions that will be asked of Ola Electric at NCLT once the case starts being heard.
Take that point, Parikshit. Thank you so much for getting us up to speed with that one stock, which is always in the news somehow. The other one is IndusInd Bank. It was the story of last week, and now the RBI has come by to assuage some concerns. Sudarshan joins in with the latest on that one. Sudarshan.
Good morning. So it was not a great week for IndusInd Bank. Last week, bank had announced that due to certain accounting mismatch, its net worth would be impacted by around 2.4%. But RBI on Saturday has given a statement on the IndusInd Bank, emphatically mentioning that its financial remains healthy and there is no need for depositors to react to all the several reports that have been coming over the last 1 week. Even it has mentioned few important ratios of the bank and saying that financials is satisfactory and bank remains well capitalized. It has comfortable capital adequacy ratio and provision coverage ratio as of Q3 FY25. Capital adequacy ratio was at 16.46% and PCR was at 70.20%. Even liquidity coverage ratio was at 113% versus regulatory norm of 100%. And now RBI has asked the bank board and management to have remedial action completed by Q4 of FY25. So because of RBI's this emphatic statement, I'm going with green for IndusInd Bank today.
All right, 672 the price. I mean, Sudarshan, thank you very much for that. Well, SpiceJet is the next one we want to focus on. Nimesh is here with details. Nimesh, morning.
Hi, morning, Prashant. So in a surprise move, the promoter and the founder of SpiceJet, Ajay Singh, sold nearly 1% stake via block deal on Thursday. He sold nearly 1.15 crore shares at an average price of 45, amounting to close to 52 crores. I'm saying surprising because this was not anticipated because the QIP price was much higher. The promoter holding is just at 29%, so it's down by another 1% now. In fact, the stock has been under pressure of late, and this will further weigh in on the sentiment. Last week, the stock ended almost 10% lower. By today, the stock is down close to 18%. I guess for SpiceJet, while this is a negative sentiment, the next big trigger to watch will be the fleet additions, because that's going to be the next big trigger in a seasonally good quarter for SpiceJet. So today it will open weak, but watch out for fleet additions going forward in SpiceJet.
Okay, all right. Absolutely, that was indeed something worth noting, that sell coming in from the promoter. Thanks very much, Nimesh, for that. Quickly hopping across to Vivek then, who's watching out for GMR Airports. And also, Vivek, I think KEC International, they've won some orders. Good morning.
Good morning. That's right. So GMR Airports, they've given the operational update as far as the month of February 2025 is concerned. So what is it that they've handled in terms of passengers as well as aircraft? passengers. Over 10 million passengers is what the company has handled as far as February was concerned, which is almost 12.9% growth on a year-on-year basis. Domestic traffic, passenger traffic was up 13% and international passenger traffic was up almost 12.7%. Total aircraft movement too has gone up quite significantly, up 8% on a year-on-year basis. Now coming to KEC International, again, order update and order wins coming across. The company has secured new orders of a little over 1,260 crore rupees. Now the orders are for transmission lines, one that the company has received from Power Grid, and also supply of tower orders coming in from the Americas region. So YTD, the order inflow for KEC stands at 23,300 crore. We are in the last 15 days of March. So, the order inflow guidance was close to 25,000 crore. The company so far has reached close to 23,300 crore.
Vivek, thanks a lot for that. And as we move towards the end of financial year, we will see a lot more order wins coming by for a lot of the companies as they rush to, close their books for this year itself. A bunch of other stocks on our radar this morning as well. Vinny joins in with a list of all those stocks. Vinny.
Good morning. So I have Tata Motors on the list. We're expecting green year. The company will be meeting on 19th of March, and this is going to be to finalize that fundraising plan that they're considering 2,000 crores. This is via NCDs and private placements. So keep an eye on Tata Motors. Welspun Specialty, that is also in focus. Now they've done an order of around 231 crore rupees from BHEL. This is in the normal course of action that they've received this contract. We had heard about this and they were L1 bidders. Now finally the contract has been signed and it's expected to be executed in the next 13 months, so April 2026, when we're expecting these projects to be completed by. Dalmia Bharat is the last one. We're expecting green year as well. It's one of its subsidiary, I beg your pardon, that is Dalmia Cement in the northeast region. That has begun production of around 2.4 metric tons per annum. This is for grinding unit in Assam. Obviously, post this, now the capacity has increased to 49 metric tons per annum from previously around 46.6 metric tons. So an increase in capacity expansion is what finally has taken place for Dalmia Bharat, and overall we are seeing that now the capacity utilization stands at around 60% on a pro rata basis. So interesting to watch out for this one as well.
All right, Vinny, thank you very much for that. Vamakshi is here with more stocks with news flow. Vamakshi, morning.
Good morning, Prashant. Let me first start off with Oberoi Realty. The stock is expected to open higher today because they've gone ahead and announced the soft launch of Sky City Mall in Borivali. This has been opened for public from March 15, 2025, and the mall has a gross leasable area of somewhere around 12 lakh square feet. This is equivalent to leasable carpet area of somewhere around 7 lakh square feet. So given this development, going with the green for Oberoi Realty. But the next stock on my radar is Fusion Finance, going with the green for this counter as well, and that is because the hunt for the CEO of the company has finally ended. They've appointed Sanjay Garyali as the CEO of the company. Mr. Devesh Sachdev, who was the erstwhile CEO, has now stepped down and continues his position as the MD, that is the managing director of the company. Keep in mind that Garyali has over 28 years of experience in the finance industry. He joins in from L&T Finance, where he led the urban finance biz. So given this development, going with the green for Fusion Finance as well.
All right, Vamakshi, thank you very much for that. Let's quickly recap our list of stocks to watch this morning then. The ones that have positive news flow around them are IndusInd Bank, GMR Airports, KEC International, Tata Motors, Welspun Specialty, Dalmia Bharat, Oberoi Realty and Fusion Finance. Stocks with negative news flow around them today are Ola Electric and SpiceJet. Well, that's our equity list for the morning. Let's move on to the world of commodities and figure out what the headlines there are looking like. We have Manisha joining in with the latest. Manisha, I was only looking at gold. 3,000 finally happened on Friday. What's the latest? Morning.
Oh, well, yes, morning. Thank you for that, Surbi. At $3,000 announced finally on the screens. We've been talking about this number since the last year. But, once you've done 3,000, you have now reports suggesting 3,500, 4,000 perhaps is not too far away. But, there is support continuing for the markets, and that is because the US dollar index is trading at a 5-month low. There is risk aversion. There is rising expectation of a Fed rate cut, especially after decline in the US CPI and PPI data. But it's not just about gold. The commodities overall are firm after the China stimulus measures. The China State Council has launched a special action on Sunday, and that clearly seems to be supporting. So you have Brent prices trading 3% higher from the previous week and continue to hold above $71 a barrel in the Asian markets right now. For the metals as well, copper is trading at a 9-month high. You have tin, aluminum trading at 3-month highs. Even iron ore and zinc trading at around 2-week highs. So everything in commodities seems to be buzzing right now.
Right, everything in commodities seems to be buzzing. So what we'll do is take a short break. Thank you for that, Manisha. On the other side, Prakash Diwan joins in for some fundamental stock talk. We'll pose this question to him as well. What are the stocks that benefit from this buzz in commodities? Welcome back. You're tuned into Bazaar Morning Call on CNBC TV18. This morning, we're setting ourselves for a positive start, led by a good handover coming in from Wall Street. The question is, where do we go from here? Because this is the very zone from where we've seen a bit of supply on the Nifty over the last few trading sessions. But be that as it may, a lot of stocks will be on our radar. Prakash Diwan joins us now. Prakash, good morning. We left with Manisha talking about how gold prices have hit a record high. And across all commodities, there has been a bit of a buzz. There has been a bit of an uptick. So, two-part question. One, on gold, would you now bet on some of the gold financiers once again? Because consensus is positive on financials and banks. So, in that, the additional, boost that gold prices are giving, could that be a buy once again? And secondly, on all the other commodities, what are your views on metals? Are you positive?
Good morning, Manglam. So, on gold, my sense is you'll probably continue to see a bit of strength coming in. But on a pure play commodity option, I would still go with silver. The arbitrage between silver and gold is significant yet. Silver should kind of play catch up. But when you overlay the gold strength into, let's say, the gold financiers, I can tell you that gold financing is no more, the domain or exclusive domain for Muthoot and Manappuram and the likes. In fact, there's so many banks that have built their portfolios on gold financing. So the best way to play that is probably take up some small size banks, which otherwise also have a very good balance sheet and a good target segment. So let's say a Catholic Syrian bank. It offers the best of both worlds. It's into SME, it's not so much into personal loans, which has become a little bit of a issue with lots of other smaller banks. And of course, it has a very fast-growing gold portfolio as well. So it does open up options for investors to kind of choose something which exactly aligns to their view, and that's where I stand. On metals and overall commodities, I think the China resurrection, whether the stimulus drives this or whether, it's the slowdown in output itself, which they've realized is hitting them so hard, could probably be very positive for ferrous companies in India for the next 1 year, actually. You will start seeing some realization strength coming in, some pricing power coming in. Iron ore costs have come down. So, that spread is something which will work. And they're all sitting on balance sheets, which are far more healthier than the last round of up move that you saw. So you'll see a little bit of that spring effect in metals for sure. But it could be lumpy. It's not something which my sense is very linear. But overall on commodities, if you really want to play, it's a special situation. But look at Vedanta. It's absolutely right for that demerger to be announced. It could probably unlock some value, if not tremendous value. The global situation in terms of its bonds, there's no discount. They've repaid a lot of the debt very much in time, unlike what was expected, let's say, about 18 months back when things were in a crisis state. I believe if copper and oil, not oil necessarily, but copper and other metals do well, aluminium and all, Vedanta will probably be a bigger beneficiary of that. There's a delta that's very easily available. So I would probably look at that. But yeah, I'm quite positive on metals, especially the larger ones who have scale and economies of scale and margin strength.
Okay, got that point. Prakash, good morning. Speaking of value, do you see value now emerging in IndusInd Bank? Now, this is not a question for the faint-hearted. It's not even a trade for the faint-hearted, right? But it's very, very interesting the way the RBI had to come out to reassure, I think, more than investors, depositors, really, not to worry, because all of the bank's parameters are within very healthy zones. Do you think the worst of the poison is out? I mean, 27-28% down in a week flat. Would you venture in if you were a bit of a brave heart for that part of your portfolio?
Good morning, Surbhi. So, no, I do understand, there are these special situations, opportunities where because of some event, the impact is kind of felt. Here, there was an attributable reason why the stock gave way. And my sense is that reason is, there's not been enough yet proven to associate from this fact that this is over and this won't get repeated, or there's no more hidden cockroaches in the kitchen. So there's always a possibility there could be some other section of the derivative portfolio which also has some missing. So till that is out, and remember, you need to invest into something which promises growth as well, not just because the problem has been discovered. Because of the problem, the stock has reacted 27% away from its highs. But my sense is you have far better, stronger balance sheets in the banking space, which will participate in the up move come April, and things would start looking very different. And look at the kind of order flow. Mangalam was alluding to this whole influx of orders that will happen before March end. But my sense is April onwards, you'll have the capex cycle actually taking much more effect. So when that happens, credit growth comes back, the better balance sheets will benefit. And look at a Kotak Bank. I'm not saying that it's something which will grow at a scorching pace, but you'll be much more safer in terms of the risk reward out there. It probably could, give you a upside which is far better than even IndusInd, because IndusInd is repair, whereas Kotak is pure growth. So, those kind of things is what you need to balance up.
Okay, well, Prakash, coming back to you with more questions on stock sectors, etc. But here's another one, right? And this is going to decide the overall broader tone of the trading environment, which remains very fluid. This is the exclusive conversation with the CNBC, our network. U.S. Treasury Secretary Scott Bessent saying that he's not too worried about the recent market correction. Remember, S&P down 8% from the year-to-date highs. He also spoke about tariff imposition, perhaps, the probability of a recession in the U.S. Listen in.
I'm not concerned about a little bit of volatility over 3 weeks, because if you look over the long term, the reason stocks are a safe and great investment is because you're looking over the long term. If you start looking at micro horizons, stocks become very risky. So we are focused over the medium long term, and I can't tell you that the market is going to go up today, tomorrow, next week, but I can tell you that if we put proper policies in place, it's going to lay the groundwork for both real income gains and job gains and continued asset gains. I was with the Business Roundtable yesterday. I think it was 135 CEOs, and I talked to them about our plan, which includes tariffs, deregulation, and what I call reprivatizing the government, and bringing down this incredible level of government spending. And one or two items with one trading block, I'm not sure why that's a big deal for the market. Look, that's the nature of these reciprocal tariffs, that all President Trump is asking is for countries to take theirs off. So we have identified some strategic industries, steel, aluminum, likely autos, but everything else is up for grabs, and that's going to be a decision that's made by our trading partners.
All right, that is the U.S. Treasury Secretary defending all of the recent policy moves and saying that he's not too worried about a market correction. Well, let's get you some more opinion. Rockefeller International's chairman, Ruchir Sharma, agreed with the U.S. Treasury Secretary on how government spending should be a major concern for markets.
This is, President Trump's favorite policy tool, and he can't help himself but use that. But the only hope here is that if they do settle on just using reciprocal tariffs, because a lot of governments around the world will be quite happy, or not happy, or at least be forced to reduce their tariff rates, and then you have the law of comparative advantage, which plays itself out. But the bigger point here for me, Carl, is this, that the American economy over the last couple of years was artificially juiced up by very heavy government spending, by running deficits that no country in the world has been running. And that was unsustainable. And the idea that America could go on that way and nothing needed to be changed, I think that was just not correct. So in a way, the correction we're seeing in the markets and even in some of the spending patterns, I think was inevitable given this bubble we had in American exceptionalism and in government.
Incredible insight coming in from the experts there. What we'll do is take a short break, come back on the other side. We'll get you some chart checks as well. Mitesh Thakkar and Shilpa Rao join in for some technical analysis. Stay tuned.
Okay, welcome back. There's 8 minutes to go, 10 actually to go for the pre-open session to kick off. Mitesh and Shilpa Rao are with us with what they want you to do as far as trades are concerned. 130 points higher on the GIFT Nifty. Thanks very much, both of you, for being here. Mitesh, good morning. What's the setup looking like? I mean, you get this 100-point bump, and then you got to do something after that. So, what's the trade here?
Yeah. Morning, Prashant. So, the idea is that with the gap up opening, you will be now then targeting the upper end of the range for the Nifty, which is around 22,600. Assuming that we open around 22,400, 420 zones on the spot, I think there is about 180, 220 points left on the upside, because significant supply emerges around 22,600, 650 zones, and then around 22,800. So I have been maintaining a positive bias despite the fact that the last few days have been very sideways, with just one attempt at about 22,677, which was on Monday last week. And on two occasions, we saw 22,300 come into play on an intra-day, intra-week basis, and the markets bounced back from there. So I think it's a range market, but good chances that, this time we should be able to clear 22,600 on an hourly or 2-hourly closing chart, and then we can even look at 22,800.
Would you have a view on the Nifty Bank, Mitesh?
I do, Mangalam. Good morning. I would be looking at a first target of roughly around 48, 150, 200, which might happen with the gap up, because the gap up is significant. Therefore, the next target of 48, 500, 600 comes into play. I think that's the range which I'm looking at. Beyond that, there's 48, 800, and then we can look at a proper sustained up move starting. But for the time being, let's keep the targets at around 48, 500, 600 zones.
All right, let's go across to Shilpa now. Shilpa, your index calls?
Good morning, everyone. Index, I believe, Nifty, as rightly said by Mitesh, there's the upper resistance band towards 22,600. So if we close, if we open around that, so we should have a wait and watch strategy out there. If we sustain above 22,600, then definitely a move towards 22,750 to 22,800 cannot be ruled out. So, but the initial dip should be a halt, and you should buy that dip when it comes towards 22,400 again, and then maybe go towards 22,800. So, for Bank Nifty, we have this broad range of 47,000 to act as a support and resistance at around 49,500. So that is how the play should be. If we go open gap up around 48,500, again one should wait it out, and any dip of 200 to 300 points should be the buying opportunity.
Okay, all right, got it. So that's the way one can perhaps look at the indices. Let's also talk about the individual stocks. Morning to both of you. Mitesh, what's on your list today?
Morning, Subi. I have all buy calls today. DMart has been a recommendation twice last week. It moved very strongly on Thursday. I think still can go to about targets of 38.80. So buy here with a stop at 37.60. GMR Airport is a new stock. I think that's something which has been consolidating. It needs to break above the 74.80, 74.90 zone. So buy above 75, keep a stop at 73.80, and look for a target of around 78. And that's something which last few weeks you've had some buy calls, because the stock is coming out of oversold levels. So still remains a buy with a stop at 12.30 for a first target of 12.85. And ICICI Bank is the final call. Keep a stop at 12.37, look for targets of 12.75.
You're betting on Reliance, and if you're betting on ICICI Bank, you are positive on the Nifty and Nifty Bank itself. Positive news flow coming in for GMR Airports as well. Shilpa, your stock picks?
Mangalam, I also had my topic as GMR Airports. I have been recommending since for the past 1 week. It is really good because the support at 70 or levels is very strong, and a move past 78, you will see levels of 85 also happening. So leaving that, I have two buys. One is from oil. Oil, I believe, is heading towards 400 zones again. So that is one stock you should look at. Keep a stop loss around 350. The other one would be again from the same sector, IOC. IOC is also looking very strong. 120 should act as a good support and look for targets of 135. The other one would be a buy in Nykaa. Nykaa also holding 160 is looking good. 170 to 172 levels should come up. I have two sales recommendation as well. First one would be in Lodha. Lodha, I believe, is heading towards 1,009.80 zones. So stop loss of 1,100, one can sell Lodha. And the other one would be a sell in Voltas. Voltas falling below 1,400 is little critical for the stock. You can see levels of 1,350 to 1,320 coming as well. So that is a wait and watch. A slip below 1,400 is a sell.
All right. Okay, Shilpa, got it. Thank you very much for all the trading advice this morning. We do have to take a quick break, come back on the other side. We'll, of course, have the pre-opening rates. Also, we are putting the spotlight on the auto space. We're halfway down the month. So how are sales trends looking as we're all set to wrap up the quarter and the year as well? Kumar Rakesh of BNP Paribas joins in with some perspective. Welcome back. Well, just about 15 minutes to go before we get to the opening. We'll start getting the pre-open rates as well in just a bit. Before we do that, Prakash, I want to draw your attention to this small little promoter selling that happened in SpiceJet. Mr. Ajay Singh has sold off, I think, just about 1%, just a little under 1% holding. What do you make of it, and any interest in the stock in any case?
So, to be honest, there could be multiple reasons for this kind of an exit. There could be some personal use of funds that the promoters have in mind. But my sense is, if you, on a standalone basis, if you compare it with the other listed peer, it still doesn't kind of give you that opportunity, whereas which a lot of people have been anticipating, saying things could start looking up, and the delta that you have in terms of how it can improve is far higher in Spice. Indigo is steady state. But I can tell you, airlines is a very high-risk business. All of us know that, the mortality rates, the difficulties. Spice will continue to struggle for some more time, at least for the next 2-3 quarters. And that's the time where Indigo could actually make some amazing headway. So my bet is still on Indigo. Even if Spice becomes more attractive at a lower price point, it might carry much more risk along with the potential reward. Indigo doesn't have that risk. So that's where the risk-reward equation turns very favorable. Wait for the Q4 numbers to be, you'll probably be stunned at what it makes. Of course, it might be one-off in certain cases, but certain parameters. But the way Indigo is doing in terms of market share improvement and efficiency and the kind of pricing that they've managed to get away with, there's no letting up.
Oh, absolutely. Q4, I completely agree, because all those flights that were going to anywhere in UP at 3x the rate, I'm sure that's going to be a big green booster for these airline stocks.
Just from a customer standpoint, the kind of rush that Indigo attendants, Indigo guys show is much higher than everyone else that you see. No other airline staff, no other airline seem to be on a mission. The Indigo guys are on a mission. Take the flight off as soon as possible, get the passengers out as soon as possible, and just be on that mission. It's very difficult to, replicate that right from the top to the bottom layer.
Guys, so couple of points, right? SpiceJet raised money from investors. I don't remember what price there was
60
the entire
plus rupees, 61 rupees.
So price is below that. The big trigger, and I remember talking to a few of the people who put in money, the big thing was, yahan se khone ko kya hai? I think the market cap was, less than 10,000 crores or something. And the big thing was oil prices will fall. Now, thing is, oil prices have fallen substantially, about $15 or so. If you see at the price where the money was put in and where the prices are now, I think about $12, $15 lower. So actually things seem to be working out. But it's just that, turnarounds are, as they say, the old saying, right? They really turn.
Yeah.
Hopefully this will turn. The business itself is very tough. But you need, for the sake of customers, for the sake of you and me, we
definitely need more airlines.
More competition, etc. as well. So we'll see how this one, but there's a big move coming in on SpiceJet. Sorry.
IndusInd Bank. It pre-opened. The IndusInd Bank stock has actually locked at 10% upper circuit. Obviously, these are pre-opened rates, not backed by... Okay, these are backed by volumes, about 327,000 shares as well. Very interesting to see where this goes. After a 27-28% fall all of last week, the RBI coming and saying that, there could be some sort of strength in the business itself. So
okay, IndusInd Bank definitely in focus. Overall, the Nifty is still stabilizing. It's showing a downtick for 100 points. So let's wait for it to settle for a bit. We're putting the spotlight on the auto sector right now. There's been a lot of weakness, obviously, in both PV sales, also two-wheeler sales, at least a month gone by, were nothing much to write home about. The vehicle registrations, March data shows a 15% decline in total registrations as well. So is this pain going to continue a while longer? What can FY26 bring? Kumar Rakesh, India Auto and IT Analyst at BNP Paribas, is joining in for some thoughts. Of course, we're talking only autos today with Kumar. Great to have you on the show, Kumar. So what's the sense so far? I mean, it's and we've discussed this with you earlier as well. In PVs, you told us that maybe financing is a bit of an issue, though companies like OEMs like Bajaj Auto kind of denied that. We did ask them about it. But what's the sense? Passenger vehicles as well as two-wheelers, will March continue to be as sluggish and weak as what we saw in February?
Hi, good morning, Surabhi. Thank you for having me on the show. Yeah, we have been on your show earlier as well. And since late last year, we have been talking about that financing, especially in the two-wheeler space, seems to be quite stretched. Delinquencies have started going up. That is pushing the credit cost of financing companies higher. And that will limit their ability to lend aggressively that we had seen over the last 2 years. The effect of that has been visible over the last 3-4 months. And we think it will continue for a while. If you look at the financing companies' performance in the December quarter, if anything, the credit cost either remained elevated or further increased. You look at the microfinancing institution, even though they are not directly financing, they do help in creating a healthy cash flow in the low-income households. There, the PAR 180 days, PAR 91 days have continued to shoot up in the December quarter. And interestingly, if you look at the states where microfinancing institutions have the highest exposure to, are the states that have seen the highest slowdown as well, as the disbursement by these microfinancing institutions dramatically slowed down in December quarter. Since December, we have been doing a lot of channel checks, and what we are gathering is that things have not improved as yet. If anything, potentially have deteriorated further. And that creates a headwind for the demand, because if the easy financing, which was one of the major tailwind for the demand, is no longer available, we'll continue to see the market to readjust at a lower volume, which is what we are seeing. Compared to that passenger vehicle, we would expect that to start stabilizing at some level. There were two major headwinds the industry was facing. One was the affordability had dramatically slowed down, but in fiscal 23-24, we didn't see much of the impact of that weaker affordability because there was still a strong pent-up demand which the industry was catering to. Now, as we entered into FY25, we simply were witnessing the perfect storm as the base was really high from high pent-up demand years, and the affordability had dramatically weakened during the last 2 years. The good thing is that both of these two headwinds we think has largely receded. We don't have a high base which entering into FY25 was an issue, and affordability that we have been tracking on a monthly basis seems to have started stabilizing over the last 1 year.
Kumar, sorry, just allow me to come in over here to understand this financing issue in more detail. Because what's happening is that actually tractor volumes have really picked up very well. So the financing issue does not seem to be impacting at least rural demand. Because if rural households can invest in tractors, I mean, would financing be a concern for two-wheelers? So the two-wheeler financing issue that you're talking about, where is that showing up? Is it largely urban centers or tier 2 towns? I'm not able to sort of understand the two because tractor sales are really improving. But two-wheelers, you're saying, are constrained by financing, including, MFI stress. So could you just elaborate on that point?
Yeah, that's a very fair observation, Surabhi, but that essentially just highlights that how the demography and the customer base of two-wheeler customers and tractor customers are not very alike, that sometimes we may confuse as they have very similar customer segments. There are some very nuanced differences between those two. Two-wheeler caters to a very large segment of the rural market. They are not catering just to the farm-exposed customers. Whereas tractor obviously is exposed only to a particular segment in the rural economy. And if you look at the rural economy's farm segment and the income growth that the rural segment is going to see from the Rabi crop, it's going to see about 12-13% of income growth. So actually the customers of tractor are sitting on a pretty healthy income growth going in in the latest harvesting season. And that is partly also helping the strong growth that we are seeing. Partly also the low base of last year is also helping in the strong numbers that we are seeing. Now, one could expand that and to say the similar benefit should reflect for the two-wheeler customer base as well. But the challenge is, as I was saying earlier, that the two-wheeler customer base is far wider compared to how tractors are. And if you look at the rural economy outside of the agricultural activity, it hasn't been as strong as the rural activity is. And on top of that, the aggressive lending, we saw almost 20-30 percentage point increase in financing penetration in a short period of time. That just tells us that the industry had gone in a very high intensity in terms of expanding the footprint in the rural and as well as in some of the urban markets. And that will need to be readjusted.
Right. What would your top picks be in this current environment?
So as you would have noticed, obviously, we would prefer passenger vehicle companies compared to two-wheeler companies. Within passenger vehicle companies, we like Maruti Suzuki from a long-term perspective, from a 2 to 3 year horizon. We think a lot of catalysts are going to start playing out for the company in the second half of next financial year. We think once they start launching their hybrid variant of existing models, that could be a game changer for the company and possibly for India as well. We'll see an acceleration of hybrid penetration in the country, something which we have seen globally in most of the markets, that hybrid powertrain tends to do much better than most of the other powertrains. We are yet to see in India, and we think that will start happening by next year. Mahindra & Mahindra is our other top pick, which we like because of a very solid growth, both on volume and earnings that they are delivering. And we think it will continue to deliver in next financial year as well. Looking at the model launches, we think there is a clear path for a double-digit volume growth. And as we were earlier talking about, the tractor segment also seems to be doing pretty well. And as we go into next year, we think some of their loss-making international tractor subsidiaries, if they exit those, there could be margin expansion as well. Finally, from a cyclical pick, we have Ashok Leyland because we think that given the price where it is, we have started seeing some green shoots, at least on the transportation activity side, looking at how the diesel demand has now started turning very strongly. The e-way bill generation has started turning very strongly. These are some of the initial signs which tells us that the demand for haulage activity has started picking up, and that should translate into better volume growth next year. And given the price is, we think the risk reward looks very favorable.
Okay, thank you very much for joining us. So that's the auto space in focus. By the way, you're talking about buying automobiles. Have you guys checked out the changes to the Motor Vehicle Act in Maharashtra and the fines and how they've moved? Fines for all kinds of offences are up between 10x to 20x.
Wow.
So that's another one.
I don't get it.
Sure. We've been told, the producers are telling us that we don't have time.
Where are the roads? Where do you drive?
Exactly.
You worry about fines when you can drive. I mean, I'm off the road.
Should we increase the fines by 10x on everyone that digs every road every month as well?
That'll make them a lot more.
I knew this would bring about a spirited discussion, but that's for later. 4 minutes to go for the market open. Mitesh is back with us. Mitesh, what do you have? 9-10 calls.
I'll go with the buy, Prashant, on GMR Airport for targets of 78 to begin.
Okay. So that's GMR in focus, about 0.6% higher. Let's talk about a couple of more stocks. Vari, Sai Life and Patanjali are 3 names we want to focus on. Sud is here to put the spotlight on these names. So over to you.
So Jefferies has initiated coverage on these 3 stocks. So we'll start first with Vari Energies. It has initiated coverage with hold and target is 2030 per share, which is 4% downside from current level. It says solar installations are set to grow at 24% CAGR over FY24 to 30, and tide is likely to turn by late 2027. Second is Sai Life. Here also it has initiated coverage with hold and target is 730, which is 4% upside, and key drivers are likely to be favorable industry dynamics, healthy molecule pipeline and adequate capacity. It expects revenue and EBITDA CAGR of 15%, 29% over FY25-27. Last is Patanjali Ayurved. Jefferies has initiated coverage with buy and target is 2050, which is upside of 20% per share. Also, it expects near double-digit top-line growth going forward.
Okay, Patanjali Foods, Ayurved is the unlisted company. For other reasons, they're getting into insurance, but they're not listed, so not within our realm for the time being. So thank you so much for that. More brokerage reports that are making it to the headlines this morning. We have Hormaz joining in on BSE, Adani Green and Adani Power. Which of these reports, Hormaz?
Morning, Surabhi. And UBS has initiated coverage on BSE. It's a buy recommendation, a 53.50 price target, which is a 37% upside from current levels. And they're saying that with this revamped business model, the multiples for BSE are of less relevance now, considering that they have revamped their business model. The other one being Cantor Fitzgerald, which is one of the Adani Group bulls. They have initiated coverage on Adani Green, an overweight rating, a 12.22 price target, which is a 40% upside from current levels. And it says that it is a compelling investment case as renewable energy is the core of its goal, considering India is moving towards net zero emissions in the future. And lastly, of course, on Adani Power as well, where they are an overweight rating, a 595 rupee price target, which is a 17% upside from current levels. Valuations are reasonable. They like the risk reward at current levels, and that is because they are expecting to add 12.5 gigawatt capacity over the next 5 years. The leverage is the lowest in several years, and India will continue to meaningfully rely on thermal power. So positive brokerage notes coming in on two Adani Group stocks and on BSE as well.
Got that. All right, Hormaz. Thanks very much. I just want to point out, interestingly, we spoke about this broad range of really positive cues. I mean, Asia is better, Wall Street recovered, Europe was in a bright shade of green, but must say that we are not showing that similar level of global enthusiasm, what we saw on global screens, because the Nifty in the pre-open, now it's all settled. It's actually still down about 44 points. Sensex is absolutely flat, as is the mid-cap index. So let's see. I mean, the implied open was far more optimistic, but the pre-open, a little more sobering.
All right, absolutely. And, we'll see how things sort of go from here. And over the last 1 week, what we've seen is that it's been the opposite of what we've had now for many months, which is market starts lower and then sort of keeps sinking, or the market starts higher and then it gets aggressively sold into. Last week, where the market was steady, about 0.5% low, 0.6% lower, Friday to Thursday, because Friday was a market holiday. It's another one of those sessions. But the first rates will start to come up. We'll look at indices and we'll look at stocks. Okay, the Nifty is starting at about 22,433, small green, small up, about 0.25%. So it's higher. Nifty Bank is up about 1/3%. And there is 48,200 plus. Mid-cap index is up 0.15. Small cap index is up about 0.4% or so. You've got about 30-35 names higher and about 20-odd stocks, less than 20 stocks, which are lower at this point in time. Too early to look at market breadth, but I mean, stocks are still opening up. But it's a decent start, about 70 points higher, 22,500 nearly, but not quite there. Surabhi.
Okay, let's get down to stocks and not bad, about 80 points higher on the Nifty. IndusInd Bank reacting well to the reassuring statements coming in from the Reserve Bank of India. I mean, RBI basically reminding everybody about the latest capital adequacy ratios and other parameters, saying the bank is in a healthy financial position, 4% up over there. Bajaj Finserv about 1.5%. Tata Motors has some green on it, 1.5% higher. Among the other large caps that are on the green side, L&T about 1%. ICICI Bank is looking good. ITC is up about 0.5%. Reliance is aiding the bulls' cause, at least this morning, so far about 0.5% higher. So these are the early movers on the upside. Let me look at what is down, I mean, if anything, in a meaningful way. BPCL, Britannia, Nestle, these are some of the names on the downside. And the tech names, remember tech was a big drag last week because of this whole concern about if the US growth is faltering, then what happens to BFSI spends. That's still kind of playing through the system because Wipro, HCL Tech, Infosys, TCS, all of them are either flat or slightly negative to start the day. So tech remains a bit of a spot for bother. But otherwise, it's looking good, 80 points higher and holding. The Bank Nifty is actually leading from the front now with a gain of about almost 0.5%.
Even in the broader markets, tech remains to be a bit of a drag right now. We have First Source, which is lower. We have a bunch of other tech names as well, which are lower. But the broader markets are a lot better than what the index would tell you. The index tells you that the mid-cap index is up around 1.5%, but we have 1,400 stocks which have opened in the green, as against 630 which are in the red. The ones which are in the green, we have Muthoot Finance, which is doing extremely well. Obviously, gold financiers benefit from gold prices being at a record high. We have a couple of these other names as well, metal names. NMDC has moved higher, about 2% higher on that counter. Bandhan Bank up about 2%. We have Hoodco, GSPL, Crompton, all of them sitting with gains of about 2 to 2.5%. On the way down, LTI Mindtree, like you pointed out, down 3%. First Source down 3%. We are seeing some weakness in Tube Investments as well, down 3%. And some profit taking on names like Polycab and Jubilant Foodworks. In the cash market stocks, the ones which really stand out on the way down, we have Gensol. Continues to fall, ended last week with a big cut and continues to fall this morning as well. post-close on Thursday, we got the outcome of the board meet where the company has announced fundraising, and at the same time they've announced a stock split as well. Street doesn't have any of that. It's down about 5% on that stock once again. Senco Gold continues to fall in this despite gold prices being higher. We'll keep an eye out on that one. Titan has opened higher, whereas we've seen some weakness in Kalyan Jewellers continue.
Just adding one more stock, which is Ola. Remember this whole issue of their registration agency, Rosemerta, saying that they should be taken to bankruptcy court. That stock's down 2.5% right now.
50 rupees, under 50 rupees now on Ola. Well, 80 points higher on the Nifty, 22,480, 490 is where we have what we have on the index right now. So it's becoming a little stronger, but we'll see. Not quite at 22,500 still. And, I think the 20-day moving average is even higher. I think it needs to travel another 100 points upwards before we get to the 20-day, which is the first solid daily moving average, above which I think there'll be more interest which starts to come through. But otherwise, it's a decent looking screen that we have. Lots of 2-3% movers, although volumes are still just about picking up at this point in time. I mean, there's actually volume on the downside as well, so don't lose sight of that. Manappuram, Muthoot is up, Manappuram is down. Mobi Quick, I can spot, is down about 3%. I'm not sure there's any news flow here. There's Phoenix Limited, which is down 1.5%. Greaves Cotton is down 2%. There's, oh boy, IKS is down 6.5%. IKS essentially is the, essentially they work with US hospital companies and insurers in the US, essentially to streamline and make their processes more cost efficient. So it's completely, the business is completely in the US. I'm not sure if there's any specific news flow here. But
there was only this article that I read over the weekend, which had nothing to do with business operations, basically highlighting how IKS is now, Mr. Jhunjhunwala's largest holding, above Titan as well. So that really did the rounds over the weekend. But again, that had nothing to do with the business fundamentals. I don't know if there's any selling that's happened, but volumes are only 35,000. I don't think any major selling.
Yeah,
but nothing on the fundamentals.
Yeah, absolutely. It's since the IPO, it's not a phenomenal performer, but of course, everything is corrected as well in the market fall. So we'll sort of dig deeper and figure out if there's anything which is affecting the sentiment in this one. Ashwini Agarwal is a market master of the day, founder and a partner at Demeter Advisors. Ashwini, good morning. Good to have you with us here. Thank you for your time. I think, are we at that point where we've already paid for our sins in that sense, the exuberance, excesses, etc., and now it's the turn of the US. So it's not necessary to look at US drawdowns and say, well, maybe it keeps a lid for a while, but we've already been through the damage. What's your sense, Ashwini? Near term and a medium term picture.
Yeah, morning, Prashant, and thanks for having me here. What you say is absolutely right. I think bulk of the damage is done. You will continue to see episodic news flow, which is concerning because the policy environment in the US continues to be extremely fluid. And you'll probably see concerns surrounding the US dollar, which if it weakens considerably following the policy actions that are ongoing in the US, might create a bit of a cloud for exporters in India. But on a bottom-up basis, now I find a lot of companies that look very interesting on valuation. So I think bulk of the damage is done. Having said this, if you go back to corrections over the last 20 years, they typically tend to be 12 to 18 months long, with bulk of the damage done in the first 6 months. And this might be a repeat of a similar pattern. In the sense that the market peaked in September of 24. We are already 6 months into it. Broad indices are down about 16-17%. A lot of damage in the mid and small cap space. And serious value emerging. So from a short-term perspective, it's very difficult to say. I think, a small rebound is quite likely in the very short term, given the extensive fall that we've had in recent weeks. But I think a bigger or a more durable bottom is still difficult to say because the policy environment continues to be extremely fluid. And please remember that, if the world is slowing down, India will slow down as well. So, taking those two things into account, I'm not sure if the durable bottom is another 5% lower or is already behind us. It's very difficult to say. From a medium-term perspective, I think one should be constructive and do some bottom-up idea picking here. That's how I think about it.
We were talking about IKS, and we'll have an alert out there for you. Just coming back to you, Ashwini, there's a lock-in which is ending, as Hormuz has pointed out earlier. So I think this is...
It's a 3-month lock-in. 4.2 million shares open up for trade in the market now.
There you have it.
And this is about 2% of the total outstanding shares. Since IPO, the stock's not done too bad. So I guess it's just people rushing to book some profits. 9% down. So all the locked-in investors perhaps want to cash out today. That could explain it.
A 10% cut now. And I think there's a very large pipeline of stock. Maybe we'll put that data out. I remember seeing in November, humongous. Big lock-ins, because we saw such a big IPO boom all the way till December last year. A lot of these 3-month lock-ins, 6-month lock-ins, then of course, a lot of that. It's not that
there's
all
also
of it.
Vishal Mega Mart. That's actually, I have the list in front of me. Maybe quickly just pull up the stocks. Vishal Mega Mart, the 3-month lock-in is ending today. The Sai Life Sciences, there's One MobiKwik. IGI anyway has been absolutely slammed hard. So these are some of the counters where either a 3-month lock-in or different periodic 1-month lock-ins could be ending today. 1-month lock-in today is ending for Ajax Engineering as well.
I'd be most interested in seeing what happens with EMS Limited, because the entire EMS space has been very much in focus. From the issue price, the stock has moved about 200% as well. But from the post-listing high, it's nearly halved. And we have 18-month lock-in ending on EMS listing, which has outstanding equity of about 20%, 1.1 crore shares. So that's MobiKwik, which is lower. Just EMS Limited is the one we'll keep an eye out on. Currently holding in the green, but remember 20% of its equity comes out of lock-in today. The stock's already corrected about 40% from its high, and from the IPO price, it's up about 200%.
Okay. So anyway, since Ashwini, we're on this subject of paying for our past sins, as Prashant very nicely put it. What about these issues? This is another risk that you're now running, right? Where, as we're seeing, this is today's theme. Wherever lock-ins are ending, people are using the opportunity to quickly get out. What would the advice be in general on some of the recent issues? How did you find the quality of paper that came in? And should one be worried? Does this become another trigger to basically get out of any of the recent listings?
Survi, I think it's not a standard answer. Because some of the IPOs that came in were very expensive and then they traded up. So, valuations became ludicrous. So even if at a 50% decline, some of the stocks that I've looked at recently to try and find out if there's any value are still trading at 50, 60, 70 times price to earnings multiple. And those are not, palatable to me. So I would say that, yes, the opening up of lock-in, if it creates a fall in the stock price and valuations are reasonable, by all means, go for it. Because, my sense is that there is a lot of panic, I wouldn't say panic, but I think a lot of uncertainty that's driving investors to take very short-term calls. And that is an opportunity for medium-term investing. But I would say that the starting point of valuation has to be reasonable. If the valuations are still in the vicinity of 40, 50, 60 or thereabouts, I would stay away. We can find plenty of things which are now in the 10 to 20 PE range, and I think that's where the value picking should be attempted. So it's not so much as selling should be something to worry about. It should be seen as an opportunity if the valuations are right. That's how I think about it. The quality of the paper you asked, some of the quality of the companies is very good, beyond doubt. But there is a valuation that one has to contend with.
And of course, if you're trading, then this kind of data point becomes very important, right? You don't want to buy something and the next day, if you're trading specifically.
Yeah.
So this is, you've got so much to track. The global stuff, local stuff, this is lock-in business now. But of course, that's the nature of things. IKS, I think, is coming up a little bit from the lows. And it's a solid business. I remember speaking with them here on the day of the listing. But of course, it's all about what you pay at the end of the day. Mangalam, what else?
What else? Just ask Ashwini a little about the consumption space once again. I mean, he didn't seem like he's very interested in anything above 10 to 20 PA because that's where value pickings are. But look at Godrej Consumer. The stock opened in the red, and from there, swiftly, it's moved higher. It's moved to the high point of trade. And in consumption itself, you know, we'll look at rural consumption. One of the key proxies is looking at two-wheelers too. So you have TVS Motors too, which too has recovered from the lows. We are seeing some traction in M&M as well. So that's moved to the high point of trade. We have a few stocks which are recovering from lows. Britannia opened about 3% lower, now just about breaking into the green. Hindustan Lever just about flat, but again, recovering from lows is what we've seen. Ashwini, any proxies that you have in the consumption play, specifically because rural is doing better and urban's expected to do better? Is this an investable theme right now?
Yes, it is. I mean, I think, you know, in the small and mid-cap space, there are plenty of domestic consumption-oriented stocks which are trading at extremely attractive valuations with very solid balance sheets and free cash flow profiles. One has to just look deeper. Unfortunately, I'm not in a position to share names. I think even in the large cap space, the consumption companies which are domestic market oriented will probably give you decent returns of mid-teens or so on the next 2 to 3 year basis. Like you said, I think the outlook for the rural demand is a little bit positive and urban demand is expected to come back as well. And I also think that the exporters will continue to get buffeted by the outlook on the rupee dollar and the outlook on tariffs and the uncertainties arising from there. So, you know, that will cause a shift towards the domestic economy. But the one space that I think we should all pay a lot of attention to are the financials. I mean, financials are really very, very attractively valued. I think many of them are evoking the kind of carnage that we saw in 2018, 2019. I don't know if things are as dire this time around because the starting point of capitalization is much higher. And RBI has been extremely vigilant ever since the Yes Bank Diwan Housing ILFS debacle over 2018, 2019. So I would be very surprised if there are a lot more skeletons to tumble out. So I think that's one space which offers a lot of value to me. I think, you know, those are the two spaces, consumers and financials that look very interesting to me.
Very quickly, Ashwini, you briefly mentioned exporters, and I know that you have a view on sort of apparel makers, textile apparel makers, right?
Yes.
You know, again, space is not done very well. Are we waiting for these tariffs or anything? I mean, what's plaguing the space?
I think, again, you know, they have done extremely well over the last 2 years in terms of select stocks, and valuations in some cases might be a little bit stretched. Second is that there is an uncertainty arising from the outlook to the currency as well as what happens to the US demand in response to all the policy action going on there. So, you know, those are the two worries. But I also think that this is a huge opportunity for India. I think apparel making is a strength for India in many ways. And I hope that the ongoing conversations that are going on with the government of India and the US in terms of putting in place some tariff agreements or preferred partner status, some of that comes through, which will put aside the uncertainty these stocks are facing right now. So I think I'd wait to see the outcome of that. But I think longer term, the opportunity is there. And I don't think this is an industry that can go back to the US in terms of manufacturing. It's just too manpower intensive for it to make sense to do it on mainland US.
Okay. All right. Ashwini, thank you very much. Great to get that perspective from you today. Pleasure having you on the show. You have a good day and we look forward to the next call soon. Well, the market's actually looking very, very good. I mean, we started with about a 70-point opening gap, and now it's expanded to almost 150 points. So the bulls are in control. The mid-cap market's doing even better. Look at the mid-cap index, up about 1%. It's a nice green shade that we've got going on the screen. Well, for the time being, we're putting the spotlight on the real estate space. There's been some concern in various pockets of the market about whether there's going to be any sort of a dip in perhaps demand for, ultra-luxury housing. Considering the 5-month-old stock market correction. Well, the next company on our radar is actually from the realty space. We've got Pavitra Shankar, Managing Director at Brigade Enterprises, joining in. Brigade, of course, has been launching lots of premium projects in Bengaluru, in Chennai. So let's get some perspective going. Pavitra, great to have you with us on the show. Thanks for joining in. And I really want to start with that question, just address it head on. First of all, tell us that, what percentage of your revenue classifies as ultra luxury? I mean, I don't know, different developers sort of bucket it differently. For some, it's above 10 CR. For some, it could be above 5 CR. So what is that segment for Brigade? And are you seeing any sort of a slowdown in inquiries, in action in that segment?
Hi, good morning. Thanks for having me. So for Brigade, our portfolio is sort of diversified across mid-segment and upper mid-segment. And definitely now that we're seeing the preference for more premium housing, we have launched a few projects on that account as well. So as far as we are concerned, predominantly 80% of our portfolio is mid and upper mid segment. And what we deem as premium housing is, I would say, 5 CR plus. So we have one project live in each of our major cities, Brigade Insignia in Bangalore, Brigade Icon in Chennai on Mount Road, and Brigade Gateway Hyderabad in Hyderabad. And all three of them are basically, inventory is above 5 crores. In Bangalore, it's a little bit lower, about 4 crores plus. Chennai goes as far as 7 to 22 crores, and Hyderabad is 5 to 15 crores a unit. And each market has been a little bit different. So Bangalore's been pretty stable. Definitely at launch, things are more active at the time of launch, and then they stabilize. We don't intend to sell out, inventory at the time of launch itself. So we are happy with the pace of sales in Bangalore. In Chennai as well, at the launch time, we sold more than 25% of the inventory, and it is stable. Although I would say Chennai is slightly slower paced than Bangalore when it comes to very premium inventory. And in Icon specifically, it's, much higher than what the Bangalore price ticket size is. And finally, in Hyderabad, we sold more than 200 units at 5 crores to 15 crores, all within the span of a couple of weeks. So Hyderabad is a completely different market entirely. So I would say different markets in Bangalore are different, in the country are different, whether you're looking at 3 southern markets or elsewhere, Mumbai, NCR. I also think it's also, it's also what are the expectations? When it is premium, we don't need to sell right away. We do need to see, stable interest in inquiries, walk-ins, people inquiring about the project, and then the eventual conversion.
But has there been, Pavitra, that's what I'm trying to, what I'm trying to understand from what you say is that Chennai has been, not sluggish, but slightly quiet. Hyderabad, things are flying off the shelves. Bangalore seems to be stable. But has there been some sort of a dip in the level of inquiries or footfalls when you launch these projects vis-a-vis, say, 6 months to a year back?
We didn't really have the very premium projects about a year ago. I would say the market was much more frenzied a year ago because the pricing was still, in the movement of going up and up. I think prices have stabilized across the board, whether you're talking about mid-segment or upper mid-segment or even premium. A lot of that has to do with the price discovery itself by developers. I think all of us know and have the right idea in mind when it comes to pricing at launch. I'd say in the last couple of years, for all of us, it was more of a discovery. Okay, let's launch it at this rate, but very quickly you could take up the rate. Now I think we understand where the market has stabilized, and these are very good numbers. The market has already increased 100 to sometimes 150% in some parts of Bangalore, for example. So we don't expect the rates to increase like that, and therefore I think even the urgency from customers to, take the decision on day one, that level of urgency isn't there. And many of them, seeing the ticket size, they do take their time. This is not the ticket size where someone just comes in on a whim and does the purchase. So they do want to understand, they do want to compare what are the other projects available to them. And I think it's still a careful decision-making, which it should be. And because all three of these markets are fairly stable when it comes to, inventory movement and all of that. So it's not speculative in any of these three markets.
You take that point, just hold on to that thought, Pavitra, because there is some update coming in on SpiceJet as well. We all were wondering why is it that Ajay Singh has gone ahead and sold his stake at 45 odd rupees, despite, the company recently raising funds at 61 rupees itself. The company said that they've done that to, fund their Spice Health business. Furthermore, he will go ahead and utilize the company has informed the The promoter has informed the company of his intention to dispose up to 3.15 crore shares to fund allotment to Spice Health. And the stock has recovered from the lows because they've also said that they will convert about 13.14 crore warrants into equity shares. So the promoter's stake, which is currently fallen because of this sale, will go up to around 33.5% after conversion of these warrants itself. So the rationale has been given. It is to fund the investment in Spice Healthcare, and the promoters increasing their stake is something that the streets taken note of. The stock, which was at around 45 flattish, has recovered a wee bit from the low. So we'll keep an eye out on SpiceJet itself. But let's get back to our conversation with Brigade Enterprises. Pavitra, you had targeted about 63 to 6,500 crores worth sales in FY 24-25. With these launches that have come by, have you made any early projections for FY 26 in terms of launches, collections, and sales?
Do you mean FY 25 or
FY 26?
FY 26. So in the coming year, we will look to increase whatever we've done in this year. I mean, we are fortunate to have received some approvals in the month of March itself. So we are looking to finish out the current year, FY 25, on a strong note. And we're yet to see where those numbers will come up. But that said, all of our launches in the pipeline for FY 26 are still looking good. Approvals seem to be stabilizing, but taking more time than we generally expect. In the coming year, we will have more launches in Hyderabad and Chennai. Those are our new markets of focus, and of course in Bangalore. So we don't really give guidance, but we're hoping to continue to increasing our numbers at the 15% to 20%, depending on the year over year in terms of value.
Pavitra, hi, good morning. Prashant here. So just to take that point forward, I think the planned supply since the start of financial year FY25 was about 12.6 million square feet. How much have you launched so far out of this?
We have, while, at the end of the Q3, we had released some numbers, but since then we've added another 4 million square feet of launch. So thus far, it's almost touching 11 million. So while we had indicated launching about 12.5 in residential, we've touched 11 million, and I'm quite happy with that. Hoping to maybe get a couple more before the year ends. But, the idea is that we'll be selling this over the course of the next couple of years. So while the timing is always, trying to get it within certain quarters, what is happening on ground is still pretty stable. So it's really a question of whether it comes into Q4 or goes into Q1 next year.
Would I be correct in saying, Pavitra, that, of course, nobody wants approvals to be delayed, but the point is delayed approvals were a problem about a year back. I mean, when things were flying off the shelf, right? I mean, very fast. But maybe not so much of a problem. Maybe things will pick up. As you said, you already have some approvals in the month of March. So is that a fair way to look at things? And could you share the planned launch pipeline for 26, or is that too early?
Yeah, it's a little early for what we would want to do in FY26. I think we still need some clarity on where this year is going to end out before I can give any kind of indication how next year is going to look, because it is a percentage increase over what we're able to do this financial year. But what I'm trying to say is that things on ground are healthy. I know there are, more comments being made in terms of how is the real estate market doing, but I still feel it's very healthy. And sometimes it is skewed by what we saw over the last couple of years, which was, every single factor that could go well was going well. And the only thing that was being a challenge was just getting the launch out on time. But what's happening on ground is still that you're still getting many walk-ins coming into site. There's a lot of excitement when a project launches. There's much more understanding in terms of what price we should launch at. So in general, I think it's a very stable and still a very good time for developers, and also a good time for people to buy, because we continue to see prices increasing at a normal rate of say 8 to 10%, as opposed to what it was 30% year over year. So I still think it's a good time for people to buy.
So it's a stable market, and that's perhaps good for customers, and then therefore good for realtors as well. Very quickly, Pavitra, I want to ask you about the other big headline from last week for the sector. I mean, a giant like Blackstone taking such interest in the residential market, right? They've always been huge in commercial, but with this buyout of Kolte Patil, what thoughts in terms of valuation for real estate companies now and for Brigade's own plans? I mean, given this kind of large institutional interest, Are you, would you be thinking of raising any further equity capital in the near future?
So we actually did a QIP in August of last year, and we've raised enough funds, and we also have enough funds being generated by our internal accruals itself to fund our land acquisition and business development. So we are quite happy with our equity position today. In terms of other real estate companies, I think everyone's just doing what they need to do in order to be ready to do more land acquisition business development. Someone like Blackstone entering the space, I think is great. It just adds more formalization to the entire sector. Good luck to them and good luck to the residential sector. The more quality players, the better.
All right. Pavitra, we'll leave it there. Thank you very much for joining us. Good speaking with you, and look forward to our next one. Well, I think the market's holding up very well. 150 odd points in the green, 22,550. And maybe now, of course, is a decent time to look at the overall market breadth. So 2:1, comfortably, 1,600, 1,650 stocks are higher, and you got about 850, 870 stocks which are lower on my screen. So this is a fairly decent screen to look at. We'll take a quick commercial break here. There were some flashes, by the way, with regards to Trump and Putin, a call. I mean, so we knew that they were supposed to speak this week. Time, date, etc. were unconfirmed, but now we know. And I think these were comments coming in from President Trump himself saying that that call is going to happen tomorrow. And with regards to Russia and Ukraine, he'd be in a position to announce or essentially talk about, resolution in some way. So that is also at the margin important for the market because those hopes of that happening quickly had diminished into the end of last week. We'll take a quick commercial break here. We connect with the management of Patanjali Foods and discuss the quarter gone by, the outlook going forward. Stay tuned.
Broader markets are doing a lot better. We have transformers and rectifiers, which is up 6%. They won an order worth nearly 700 crores. KEC International, Vivek told us this morning, a 1,200 crore order. That stock continues to do well as well. And we have a bunch of other, infra names, TD Power, etc., which are spiking as we speak as well. But Patanjali Foods, that's the stock on our radar. Jefferies has turned bullish on the stock. In fact, they've initiated coverage on the stock with a buy rating. Target price upwards of 2050 is what their target price is. They expect near double-digit top-line growth coming in for the company, along with margin expansion as well. So to discuss this and talk about the growth outlook, we have Sanjeev Asthana, who's the CEO at Patanjali Foods, joins in now. Thanks a lot, Mr. Asthana, for joining in. Before we get to this business, I just want you to, for our viewers, set the record straight on the insurance foray that has come in from Patanjali Ayurved and has nothing to do with Patanjali Foods. Please, you do it yourself.
So that's absolutely right. It's got nothing to do with Patanjali Foods, the parent company. That's what's there in the marketplace. They are working on it, and we'll see. Of course, it is subject to all the regulatory approvals, etc. But Patanjali Foods per se, either in terms of involvement or otherwise, will have nothing to do with that business.
And no financial liability whatsoever either, right?
None at all.
Perfect. Thank you for setting that record straight. Let's get to business now. The last time you joined us, you did say that oil prices have been volatile. From the highs, we've seen a bit of a decline in edible oil prices, etc. as well. So far, how has business been? How has consumer sentiment improved over the last month? What kind of volume growth can we expect along with margins in your oil business in the fourth quarter?
So two sort of set of events are driving the change on the edible oil side right now. One, that we are clearly witnessing some bit of slowdown in the imports. In terms of volume terms, that is more than made up by the oil inflation that we witnessed. But broadly, for the year, we are pretty confident of still meeting between 2 and 4% of growth target on the edible oil volume. Pretty confident about exceeding 4% plus of EBITDA margin on the edible oil side. On the FMCG regular businesses of foods and non-food, there is some slowdown we see in the urban area, so that continues. But broadly, we are pretty much within the ballpark range of 8 to 10% target that we are on the food side. The HPC business is still integrating. The first full quarter we'll see in this last fourth quarter now. And pretty much we are on course to achieve 15% growth on the HPC side next year.
Right. So, let's revisit some of those numbers. You said that 4% EBITDA margins in the edible oil business will, maintain. Is that on the cards? And 8 to 10% in FMCG food segment. Will that happen in the fourth quarter, or that's a more medium-term sort of target?
That's pretty much for the annual, business itself. So pretty much on course to both the numbers. And, there's nothing that I foresee now in the balance part of the March for anything to come in which can dramatically change that. There might be minor changes here or there, but pretty much on cards that we should achieve both the numbers.
HPC business, you had earlier targeted about 900 to 1,000 crores in FY25. Will you meet that? And 3,000 to 3,200 crores in FY26?
So that's pretty much on the cards, as I mentioned. So we feel pretty confident about 15% growth rate next year. So that should pretty much take us to the numbers that you mentioned. And this 15% CAGR allows us a lot more, headroom for expansion that I clearly see in non-oral category as well. So oral is a fairly dominant part of a category. We're expecting that pretty much in the home care, personal care, and hair care, also for that expansion to happen now, under the fold of Patanjali Foods now. So next quarter onwards, which is first quarter of next fiscal, we're pretty confident that we should start getting back on stream and build up that 15% growth momentum in the business.
Just a couple of more questions before we let you go, sir. One is on the oil palm plantation. The street believes that this could actually be 20% of your revenues and a decent contribution to your EBITDA as well. When does that happen, and what are your near and medium-term targets here?
So it's happening, every year. Every year, our EBITDA run rate, what used to be about 160, 170 crores, we are upwards of, somewhere around 220 crores odd we make as an EBITDA. So every year that is spiking up. But the big growth in the EBITDA and the contribution to the revenue shall happen maybe in 3 years' time, when all the plantation momentum that we have of last 2 years, I think will start to fruit. So pretty much from 28, 29 onwards, you will see a big expansion. And that the estimation is broadly that, if the run rate of our targeted sort of plantation size, the margin expansion that we expect to happen. So we should pretty much be nearly 3 times of where we are today in 4 years' time, and pretty much 5 times of where we are today in 8 years' time.
Right, and final question. This is with regards to some of the regulations and macros in general. We heard the Prime Minister speak about, people wanting to reduce, or him wanting people to reduce their intake of oil, etc. Would that be a macro risk to the underlying growth that we're seeing in the oil business? And there were some run-ins that came in from the FSSAI as well. This was specifically on your red chili powder business. So these two continue to remain a bit of risk or the overhang on demand growth itself, right? For oil, if the underlying business itself is not likely to grow as fast because people are staying away from that, could that pose as a risk? And secondly, the risk of regulations, that people move away a little from packaged foods in general.
So I'll address both the questions. So one is what Prime Minister exhorting people to reduce their consumption of edible oil. That is, of course, I think from a health perspective or otherwise, I don't think there's any fundamental shift in reducing the demand per se. And I don't believe that is going to have a big impact on the per capita consumption. We are significantly lower than the evolved markets of the West, and even our Asian peers also. So there's a lot of headroom for growth, and I don't believe that anytime soon that any substantial reduction, voluntarily or otherwise, will happen on the edible oil consumption. And on the red chili powder, we have already issued the clarification. It was a very small sort of lot of which had a problem. Most of it, we have recalled already. And that was pretty much led by, certain challenges which Indian spices had in Singapore and Hong Kong earlier. And so it was part of that process. So we withdrawn. It was very, very small lot and part of a much larger business portfolio. So those are things behind us. And I think, once in a while, this may happen. But pretty much we're working in terms of removing this completely so that quality should not be an issue on any product that Patanjali brings to the marketplace.
All right, we leave it there. Thank you very much for taking out the time, speaking with us here at CNBC-TV18, and speak to you again soon, sir. Good luck. There is Patanjali in focus. Well, look at Ola. Stock's down 5%, and it's got decent-sized volumes as well. Actually, volumes are very large on Ola on the downside. Across on the NSE, fifth largest volume loser. So it's going down and is getting sold with large volumes as well. IKS is still down 8%. LTI, Mindtree, of course, that news out of Citi, 4.5% lower. MobiKwik is down 10%, 11% now on MobiKwik. So fair bit on the downside, even though the broader market still remains pretty healthy. 150 on the Nifty and 2:1 broader market advance decline ratio. Tata Technologies is the next company we are focused on. We have Warren Harris, Managing Director and CEO at Tata Technologies, joining us now to talk to us about business and how things are looking. Mr. Harris, thank you very much for joining us as always. Prashant this side. I mean, you derive a fair portion of your revenues from the auto space. And of course, the sector has been reeling with significant uncertainty due to tariffs. There is slowdown due to competition and EV incentives, etc., being rolled back as well. Could you tell us how are your clients behaving amidst all this uncertainty? Are they holding back in handing out new projects, etc.?
Well, I think it's been a choppy environment over the last 12 months. You know, certainly here in the US, the extreme policy positions that the Republicans and the Democrats were taking made for very difficult investment environment for our customers. The lack of clarity up until November, I think, was very distracting for many of not just the OEMs but also the tier ones in Europe. You cited the runoff of incentives. We've also got the threat from China. So it's been a difficult 12 months, and yet I think at the beginning of this year, despite the tariff kind of overhang and the lack of clear policy clarity here in the United States, I think the environment is starting now to present an investment platform against which, again, we're starting to see the green shoots of improvement. So, you know, whilst it's been a difficult last 12 months, we are hoping that the improvement that we've seen January, February, and March will continue through this calendar year.
Got that point. Mr. Harris, let's talk about the automotive segment in particular, which it was, of course, subdued in the third quarter. Is there any improvement so far in Q4, and what's the outlook for FY26?
We're seeing momentum build, and so we are expecting to finish the fiscal year well, and we are seeing the opportunity for momentum to build in the new fiscal year. We are relatively bullish for not just automotive, but for aerospace and industrial heavy machinery. The growth rates of the addressable space that we are focused upon are double digit, and we expect to intersect with that. And we are hoping that as we move into next year, you know, many of the sort of headwinds and the distractions that we've had to grapple with will be mitigated, and we'll get back to where we were, you know, FY23 and FY24.
Well, you know, the highlight has been the double-digit growth that you are targeting in your addressable market. This across three segments: auto, aero, and industrial machinery. And add to that, the question is, this double-digit growth in TAM, does it translate to double-digit revenue growth as well? Will that be higher than that?
Well, when I refer to the 10-12%, I'm referring to auto, aerospace, and industrial heavy machinery. The addressable space for us is just over $200 billion, and that space. So those are the verticals that we are targeting. Those are the verticals that we are focused upon. That space is expected to grow somewhere in the region of 10-12%. That's what Zinnov have confirmed. That's what other industry watch organizations are asserting. So we think that collectively that will provide the type of tailwinds that will support our return to not only growth but double-digit growth as we move into the new fiscal year.
All right. Warren, so double-digit growth as you move into the next financial year. Is it possible for you to break that up into aerospace, industrials, and automotive?
Well, we're expecting, because we're coming off such a, you cited the percentage split of our business. Industrial heavy machinery and aerospace is a much smaller part of our business than automotive, and so we expect percentage growth in those areas to be much higher than what we're seeing in automotive. But we are expecting momentum and growth to sustain across the three verticals that we are targeting, and we are, our confidence is reinforced not just but through the research that's come from the industry watch organizations, but we're seeing it from our customers as well. We're seeing the order book starting to grow. We're starting to see decisions made, and that's informing the type of confidence that underpins the numbers that I've just shared with you.
All right, so growth momentum seems to be coming back. So then let's talk about margins as well. You're at about 18 to 18.5% right now. The company has stated in the past the goal is 20% margins. Do you think that you'll be able to get to those targets maybe next year?
I think in terms of margins, you're absolutely right that our aspirations, our North Star as far as margins are concerned is over 20%. We expect to make improvements to margins next year as the business scales, but I think it's likely to take several years before we get to the 20% mark.
There is so much tariff uncertainty, and you believe that it's not going to be a drag on your growth in this year. I mean, what is it that makes you confident?
Well, I anticipate that the lack of clarity that we've got as far as tariffs are concerned will resolve itself in the next month to 6 weeks. I think that there is clear direction in terms of where the current administration in the United States wants to go, and I think as they're implementing the changes that they have made clear that they want to make. Whether we like the tariffs or not, it'll at least provide clarity in terms of the market conditions. And I think it's clarity that's more important than whether we have tariffs or not. I think if the tariffs present themselves as is being suggested, then the market will adjust and investments will be made. And so I think the current uncertainty is likely to be short term, and I think medium to long term we'll know exactly where we stand.
Absolutely. The world waits for more clarity on that issue of tariffs. Thank you very much, Mr. Harris, for joining in and giving us a sense of the business. We do have to take a very quick break now. On the other side, back with the markets, and we'll get Mitesh to give us some more trading ideas.
Okay, welcome back. We've got the market, which is at about 22,535, 140 points in the green. A little bit of drop-off coming through in the last couple of minutes or so. I've been sort of highlighting a few things on the downside. Maybe just look at a few things on the upside. KEC was not there in the mix in the morning, but it's the biggest volume-led gainer on the NSE now. 6%, 6.5%, and huge volumes coming through on this one. Muthoot Finance is another one. Muthoot Finance, of course, I mean, the news was that they've crossed 1 lakh crores in gold AUM, gold loan AUM. That's a 5% pop. And of course, I mean, it doesn't look like, this rapid rally in gold prices has impacted disbursements at all. LG Equipment, I mean, we don't talk about this name very often, but it's the third largest volume mover. That's LG Equipment. That's 7.5% on the NSE. That's a big one. And look at something like a MCX. Actually, two exchanges. One is MCX, 4.5% pop, and that's about 5,025. And IEX is up 4% as well. So yeah, there's exchanges, but there's also, I mean, Hitachi, which is up 4.5%. Stocks back above 12,500. So that is again, big volumes for a large name in terms of value of the stock at this point. So there's a fair bit happening on the upside at this point in time. When I can sort of name more names, and we'll do that as we go along. Mitesh is with us for now with what he'd like to do now with this gap up and, of course, what we've had over the last 45 minutes or so. Mitesh, your sense of things, whether this will last, whether we'll be able to build on this, and your trades.
Yeah. Prashant, I think, to me, it looks like that we might actually be able to slightly build on this for the simple reason that, HDFC Bank, which is both a part of the Bank Nifty and the Nifty, is turning positive. We had a buy on ICICI Bank earlier in the day, in the morning call. So I think both these stocks are looking good, and that could lend some strength to the Bank Nifty as well as the Nifty. So I think I'll take the chance that we might, actually hit 22,600, 650 zone, which is about 50, 60 points away from here. And with that kind of view, the stocks that I would recommend as a buy would go with a stop at about 181 and a target of 195 to begin with. Though I suspect we might eventually look at a slightly higher target, but yeah, 195 should be the first target over here. And the second stock, which is on my radar, that's a buy on Indigo Airlines, or Interglobe Aviation Indigo Airlines. That's the one. And this I would recommend buying with a stop below levels of 47.10 for targets of 48.50.
Take that point, Mitesh. Thank you so much for joining in. HDFC Bank doing well, giving it company on the way up. Our ICICI Bank and Kotak Bank as well. Infosys, in fact, too, has picked up. But a lot of stocks on our radar on the downside. Hormaz joins in with the stocks where lock-ins are ending today. Hormaz, a lot of stocks.
Indeed, 7 of them to be very precise, and 19.5 crore shares become eligible to trade as the shareholder lock-ins ending today. But it needs to be specified that, of course, not all of these shares will be sold in the open market. Of course, they only become eligible to trade. And a lion's share of this 19.5 crore shares belong to Vishal Megamart, with almost 15.5 crore shares becoming eligible to trade. 3-month lock-in ending today, 3% of outstanding. Not a significant movement on the stock though, but the one that is seeing significant movement is MobiKwik, and that is where around 6% of the outstanding has become eligible to trade today. 46 lakh shares are becoming freeing up for trade. The stock now below its IPO price. Ajax Engineering is the other one, 30 lakh shares, 3% outstanding, freeing up for trade, and the stock is also below its IPO price. IKS is the other one that is seeing sharp cuts in today's session. 42 lakh shares, or 2% of the outstanding, becoming eligible to trade in today's trading session, and the stock too is down almost 25% from its IPO price. This is before today's fall. Now, Sai Life Sciences is the other one, 4% outstanding, freeing up for trade, 83 lakh shares to be precise, and that too is on the radar today. EMS is the only one that is still having some significant gains from its IPO price despite the correction that it has seen from the top. 1 crore shares, or almost 20% of the outstanding, freeing up for trade. And lastly, Ratnavir Precision, here too 20% of the outstanding becoming eligible to trade, or almost 1 crore shares. So 7 companies, some of them seeing really sharp cuts in today's session.
All right, Hormuz, thank you very much for that. That's IKS, the big one, of course, but there are many other names, as Hormuz highlighted, which are reacting to these lock-ins ending. And it's a fragile kind of trading environment, and it's showing up in a big way, outsized way for these individual single names. Time for a quick commercial break here. On the other side, our segment, Market Masters. Lata will be in conversation with Ashish Gupta of Axis AMC, and they discuss bond markets, whether things are getting a little robust on the bond side. And of course, what's the outlook for the banking space as well? The big story last week was IndusInd, but they'll talk IndusInd and more coming up in just a bit.